So we're looking at the day 2 of PAL testimony. I'll be testifying here in about 15 minutes or so. Presently, we have the 5-minute chart on ES. So I'm favoring the downside here initially, but that's not to invoke any interest for you to take a trade, obviously. So let's go over real quick and take a look at the dollar index. Okay, on the daily chart. Okay, and this volume imbalance in here is where I took your attention 2 weeks ago, and I maintained the bullishness on dollar. Even through all this here, I mentioned that I'm not abandoning it reaching up into this volume imbalance and above these relative equal highs. So that sets the tone for what? Risk off. So it would be lower prices for ES, lower prices for NASDAQ, lower prices for stocks, lower prices for Forex pairs that have the name with the dollar index as the second currency in its pair name. If it's the currency pair that has the dollar first in its name, then it would be a bullish foreign currency. All during this run up. Okay, so I'm going to add the lipstick here so that way you can see. We looked for this down here, then from here, we waited for the shift in market structure here. We're bullish all through here. Volume imbalance here. Rallies up, another smaller little volume imbalance in here, which we traded back down into yesterday before they rocket up into the rejection block, which is this closing price on this candle, and then the consequent encroachment of this wick, which is this level here, and then the old high, and then ultimately up into the volume imbalance, which it was delivered to beautifully. That, my friends, is exactly what you're looking for. That's algorithmic price delivery. It has nothing to do with retail. And it's very interesting to see these things repeat over and over again, even though I've been watching it for 3 decades. Incidentally, for those that you're watching, if you are noticing that the stream, because I'm looking at my cell phone as a way of verifying that I can see what I should be seeing, even for the cell phone users. I know a lot of my students actually just watch things through their cell phone, which I don't understand that. You need a bigger screen, in my opinion, but it's probably looking very fuzzy or like not very clear, maybe blurry. If you look in the lower right-hand corner on desktop applications for YouTube, you'll see a little gear symbol. Click on that, you can change it to high definition. For cell phone users, if you touch the video screen that's playing back right now to you, touch that in the upper right-hand corner, that little gear, tap that, and you want to go to quality. For whatever reason on the live streams, it auto defaults to 240, which is garbage. So you want to tap on the quality and then go to advanced and then go up to 1440 or 1080 or whatever your internet will permit you to do before it starts to bog down. If you do that, it should snap into high resolution for you. I see a couple folks constantly referring to that after the fact on my Twitter feed. So big delivery on the upside. Even if we didn't have the PAL testimony at 10 o'clock on the heels of a large range day like that and delivering to a target, which is this here, that right there cools the jets for me for the week. Now, I know some of you action hounds, you want to like, whoa, what's next? That delivered, now what? Now what? What are we doing next? Well, we're sitting still. And that's how you hone patience and self-control. And also, PAL testimony at 10 o'clock can change all this. It can rocket up even further for dollar index and send the indices and foreign currencies lower still today. Or we could have a retracement back down into this area here. At this point, I want you to understand my mentality and the position I hold once I have a weekly objective reached. I stop. I know that's hard to believe. I know you see me get in here and trade inside intraday price just about every single day. But when I have a weekly objective like this, I teach my students, and I also like to stop. Incidentally, as a reminder, this week is non-farm payroll protocol, meaning this Friday we have non-farm payroll. I don't trade that day. I don't advocate any of my students should be doing it either. But I know some of you like to get on here and say, well, ICT doesn't know what he's talking about. Look at this trade I took. Okay. Do it live. Trade it live. And then let everybody see what you were doing beforehand. I just don't think it's a worthwhile venture to take on the risk that comes along with trading on the Thursday and the Friday of non-farm payroll. The reason why, and this is for those that are trying to actually learn here, not just spectate and watch ICT Netflix. In your journal, you want to be recording that the weeks of non-farm payroll, which is typically, but not always, typically the first Friday of every month. Now, obviously, last Friday, we had a Friday in March, but it didn't post as what? Non-farm payroll. So it's this week. So tomorrow is Thursday. That's the day before non-farm payroll. We don't trade that day. And we don't trade on non-farm payroll Friday itself. The probabilities for precision fall off precipitously in Thursday and Friday of non-farm payroll Fridays. So the protocol for this week, every time there's a non-farm payroll Friday, your task as a trader is to get all of your business done by right now on Wednesday, New York session, AM session. Once we get to 11 o'clock in the morning, it's over. It's done. It's in the books. You do not trade. You do not push the button. So you don't want to be going into these particular weeks of the month where there's non-farm payroll on Thursday and Friday of that particular week, just pushing the button to see what happens, because you know what they say, F around and find out. And this week historically has done damage to me. I've allowed it to do damage to me. I've blown accounts. That's plural, folks. Okay. I have no shame in telling you, while I was learning all this stuff, I literally smoked my accounts on these particular weeks because I was trying to force something, because I believed other people saying, these are the weeks you're supposed to trade. Look at all the volatility. This is where we got to get in here and make our moves. When the algorithms are really, really not keyed up in terms of precision, there's a lot more interest for them to be a manual intervention. That means a human comes in and intervenes and causes the market to go just outside of, or well beyond, what would be reasonably expected using the things I'm teaching you. So that's not a weakness to say this, okay? It's a strength, knowing where the odds are against me, whereas the classic retail trader, they just see it as, oh, it's just another trading day, so therefore I got to go out there and push my edge, and then their edge is dulled because the market doesn't provide the conditions that would be conducive for high probability, low risk. And that's the reason why. So all of that, if you didn't get it all, rewind it later on and write that in your journal, because that's the reason, that's the rationale behind why I teach my students. That's why I myself maintain a sideline position on Thursday and Friday of non-farm payroll weeks. And traditionally, if I don't have anything on in the morning session, I'm done on Wednesday. Now I can, and I have traded morning sessions up to 11 o'clock. Sometimes it was a deviant and traded in the lunch hour, but we can't really do that today because we have what? At 10 o'clock, the Fed chair at 10 o'clock testifying. So in about 3 minutes or so, less than 3 minutes, we'll be seeing him bring his influence in the marketplace, if you want to call it that. I don't believe that's what's going on, but they like to use the Fed chair to do those things. So let's go over to ES. All right, so we're going to drop down into a 5-minute chart. All right, so initially what I was watching was, let me go to a 15-minute chart. We have a buy-side liquidity pool here, which we've swept above that. And if you look at the 60-minute chart, that's this candle's low. This candle's high. That's the SIBI. It's a fair value gap. That's what I've extended over here. Let's drop back down to a 5-minute chart. And then inside that high, we have a small little fair value gap here in the form of a SIBI. Trades up into that right at 930. Hit that beautifully, perfect, and then came back down, swept the new week opening gap, and now we're back into touching that 60-minute fair value gap. We had relative equal highs here, so that 930 run into that fair value gap took out the buy side. So traders were caught long, took them back below the lows here, and rejection block. Most likely probably stopping them or scaring them out. This morning, I do not have a clear indication as to how I would engage it. So we're really basically just observing. If you're one of those very highly critical viewers that get to the point type thing, like yesterday was very succinct. It allowed me to cover things pretty expediently, and I don't foresee that probably happening this morning. So if you're one of those really lazy viewers, students, that's probably going to be not what we see today. And you can probably just catch this video when it's convenient for you over the weekend or something. But for the real students that are here to learn how to read price action, this is a really good exercise to watch the effects of the Fed chair talking. Now, obviously, it's 10 o'clock. Already 10 o'clock. What has he said? He probably hasn't even had the opportunity to say good morning yet. But look at the flurry of action in here. And here's our new week opening gap down here. If you look at the 930 high, okay, so all I'm going to be doing is pointing out things that are noteworthy for you to have in your journal and showing the points of reference that I'm referring to here, and that way you can study it after the day closes. But this wick here, see that? It went up into that fair value gap, cleared the buy side. Once it did that, watch what this is doing here. Where is it returning up into? Yes, it touches the bottom of the 60-minute fair value gap. Yes, that's permissible. But where are the bodies? Where are the bodies at in these two candles? In deference to this wick. Look at that beautiful return to another week opening gap. It's beautiful, isn't it? It's beautiful. So the next one of interest to me, and I'm sure you probably saw it when I was flashing my screen, which is on the daily chart. Way down here. Okay, so we have to use other tools in our repertoire. Not to say that it can't crash down here. I mean, anything can happen. I'm not saying that's happening today, but that's the next new week opening gap that I have on my. So if we have the focus on that wick right here, and draw a fit on it so you can see. But ICT, I could have shorted there. Yeah, you could have. It could have ran up higher into that 60-minute fair value gap too. You have no idea. I don't have any idea what the Fed chair day testimonies is going to present in terms of volatility. But look how beautiful that retracement is off that 39.7450 line. It's almost like it was programmed, isn't it? So this price level here is, oh gosh, can't make that out. 39.92.75. The closing price here comes in at 39.93.75. Now it's 93.75. 93.75. 93.75. So the close, yeah, 3.993.75. So the close comes in exactly at that price. I'm going to sit right up here. See that? That's probably random. To most viewers that are casually just watching, that's just randomness. But that's not randomness. That's algorithmic. It goes right to that. Now, the wicks can do the damage. It goes just outside the lines. And this is how the algorithm hides in plain view. Prior to this drop off here, that candle right there is 9.55, and we started another candle here at 10 o'clock. Powell didn't even get a chance to say anything. And right off of consequent encroachment, after tapping the 60-minute fair value gap that I mentioned, ran all the way down to what? New week opening gap here. Look at the beautiful delivery off of that, back up into another new week opening gap. Now, take PAL out of the conversation. Say that wasn't a factor this morning. This run up to that 60-minute fair value gap would have been a short for me. I would have smacked that. As soon as it went up and hit it, I would have done that. Why? Why would I have done that? And I can say this because you've watched me call these things live now for weeks and months on Twitter. You've watched me execute using the logic that I'm teaching you. So if you're going to wrestle with this and say, oh, this is woulda, shoulda, coulda stuff, move along. There's other people out there YouTubing, and you can be entertained by them. But I would have absolutely smacked that as a short entry had PAL not been a factor this morning. The reason why I would trust that is because we've already done the buy side here, and it also went up into the next premium rank, which is that fair value gap there. So I would feel comfortable getting short there with a stop above the fair value gap once it hit that. It at one time when it was bold-faced green, all body, no wick at all, when it was touching that, that would be terrifying to the average trader. It doesn't make any sense to sell short into something like that. Rate of consequent encroachment of that wick here, after hitting the 60-minute fair value gap low, expansion occurs all the way down to some random 39.74.50 level. This entire run back down into that there, it only went 1/4 point lower than the 39.74.5 level. And that's a gap that's already been traded. At any rate, let's take a look at NASDAQ real quick. Slightly. Pretty much the same delivery, but that's not a gap. These are my SMT studies. I'm just showing the NASDAQ and the Dow while I'm looking at ES. So let's go back to ES and let's see it. So that's all it is. Just comparing. Nothing in here outside of what was just delivered there is of any importance to me now. I'd be interested to see if it can mount a deeper run into that 60-minute fair value gap. Let me show you what I'm looking at specifically when I'm referring to it. Let's scrunch this up here. All right, so we have inside the upper portion of that 60-minute fair value gap. Should we extend above? Because we've already dipped down in here. I was pretty aggressive, and we had a nice little retracement off of the level that is the new week opening gap. When I say the new week opening gap, I'm not referring to the present week. I refer to every new week opening gap as new week opening gap. If you want to have a structure to your identification, let me go back here real quick. This order block here is what I'm looking at in upper boundaries. That way I can go back to discussing the relationships between the new week opening gaps. If you want to have like a labeling system in your own charts that want to have like representing what new week opening gap, like you can label them by date using the Sunday gap opening price. That would be your new week opening gap label. So if you're referring to it, you're referring to the difference between the previous week's Friday's closing price on settlement. The labeling system that you can utilize is obviously up to you. You can call each one of these individual new week opening gaps whatever you want to keep referencing or reference them, in a manner that is helpful to you. I don't personally require that because I know if I'm bullish or bearish, I'm looking for close proximity new week opening gaps below me. So it's really not technically difficult to understand, as you'll see tonight. It's not a lot of acrobatics that are required, but the insight that it gives you. Look at that fair value gap. The new week opening gap down there at 39.74.5, and look where we're at right now. Isn't that beautiful? Like, that's beautiful to see something that is completely hidden from everybody else outside this community. They had no expectation of seeing it going around to those levels. They had no expectation whatsoever. But you're seeing it. We've been seeing it day after day after day after day, delivering. And what's actually occurring? I mentioned it before, but because this might be your first time seeing it, so I don't know when you're coming to the channel, but a new week opening gap is a real dynamic fair value. It's a range between two specific price points that are fundamental, if you want to call it that. Where did we close the previous week on Friday? And where did we begin trading this new week on Sunday? Between those two price points, there's what? There's uncertainty. And uncertainty builds what? Opportunity. Where there's a difference of opinion, that's where the trade exists. Everyone that thinks it's going higher, opposed traders thinks it's going to go lower. That means you have a buyer and a seller. That's the reason why the new week opening gap works, because there is a real liquidity void. There's a separation between those two price points, previous Friday's close and Sunday's opening price. So what the market algorithm does, it delivers. Buyers and sellers don't take it there. You might be fortunate enough to be in a mood that rides to these levels. You did not push it there. Everyone on the trade with you in that right direction did not push it there. It's going there regardless. That's the part you don't understand. And I don't care who you are. I don't care who you worked for, who you work for now. It doesn't change the facts that this is going on every single day. And I'm predicting it. I got case studies after case studies on Twitter. And now traders are using it, making real money. Price is going to that range between Friday's closing price and Sunday's new opening price to offer fair value to the marketplace. For you and I, not necessarily. It's for large fund interest. It's to get large funds to bring their trades into the marketplace. Because what? Smart money, they're not doing one contracts. They're not trading 5 handles in a day. They're putting in size. And how do they put size on? They have to have a counterparty that is equally, if not more, interested than they are. So the market delivers it by algorithmic principles, and when that price gets delivered, because it's going there anyway, once it goes there, large funds either come in or get taken out. And that provides the counterparty liquidity for this entity that is deemed smart money, which is not bank traders at UBS, Citi, Credit Suisse. No. We're talking up above them. So we're halfway between one new week opening gap and the lower one that made the low of the day so far here. And we're about the midpoint of that long wick. So that's consequent encroachment. So I'm my eyes there. I'm watching it here. I believe I'll have the video up by 10 p.m. my time. So that way, don't be sitting like on bated breath, waiting for the video to drop. Prior to that, about 10 o'clock tonight, my local time, which is East Coast time on the U.S. That's when it'll be. It'll probably be about 15 minutes or less of a video. It's not going to be very long at all. Very short, succinct, right to the point. This is what you do. This is how you make them. And this is how you dress your chart with it. Note the reaction halfway on that wick. See that movement? There's your consequent encroachment at 39.80 3/4. The low on that candle comes in at 39.80 1/2. Only went one quarter of a point, one tick below consequent encroachment, and then look at the reaction there. That is tradable. That's algorithmic delivery. Not random at all. So even in this sloppy mess, you can still see signatures and notes. That's the benefit of us being together today. That's all I'm doing. So think about the delivery from consequent encouragement down here, which I talked about at the time. It's not cherry picked, okay? I told you to watch this at the very second as it was trading there. And where it delivered from here all the way back up into this 60-minute fair value gap. Where's the buy side? Resting right above here. So we went all the way down to this new week opening gap low. We're inside the 60-minute fair value gap again. We've already did the buy side here, so that's not what we're interested in. We want to see, does it want to go above this high and trade into this order block? And completely maybe come all the way back up to the high end of that 60-minute fair value gap. Because it's already pierced this low and this low. What was below these lows here? Sell side. How far can it go down below an old low ICT? How far? How do you know how far it's going to go and it won't keep going? New week opening gaps, new day opening gaps, opening range gaps, the gaps between where we closed yesterday and where we open at 9:30. There's 3 specific gaps right there. I'm not going to have all of them this week, but I'll have the new week opening gap tutorial video tonight. And I don't know when I'll do the new day opening gap video, but that'll be next. And then I'll do the opening range gap video. So that way you'll have the details on gaps and how I internalize them, how the algorithm will refer to them. There's so much if you just simply put down the willingness to want to arm wrestle me and stop trying to say I'm rebranding anything. None of this is anywhere. It's not in any books. You can get yourself $1 million if you can find it in print. Told you that. 1996, that's when it was codified. Sorry, that's me. But that range movement from the consequent encouragement of this wick, after clearing the sell side below this low and this low, I'm going to drop a line on it. Okay, so that way you can see. So below this low here, oops, sorry. Should be on that one. Okay, so we have 2 lows here that are relatively equal. And you always want to put it right on the lower of the low between the 2. So that's, I'm a little bit below it, that's okay. But from here and here. So what's resting below that? Sell side liquidity, sell stops. Traders that would want to protect a long position, they put their sell stop below that. Traders that want to sell short on a breakout, thinking that weakness that comes in, they would see that as what? A reason to be short. So if what I'm teaching you is we attack that liquidity. And the question that comes up a lot is, okay, how do you know how far if you want to be buying these stocks? But the question many times comes up is, how can you trust? How do you know? How do you know then when it drops below old lows to be a buyer? How do you know how far it can go? Like, where would you place your stop? Well, in this case, this helps a lot when you have information like the new week opening gap, because we would expect it to drop down. This was in the chart. It wasn't off screen. It was mentioned to you that this is an interesting level. If we drop lower, this is where it's going to likely draw to. It's below these relative equal lows. So below here is sell side. So there's layered sell stops below these lows that you don't know. So how far can it drop down below old lows? New week opening gap, new day opening gap, opening range gap. There's your 3 tools. How far can you trust the move above an old high for a turtle soup? I just taught it to you. So the market drops all the way down through relative equal lows into some random level, new week opening gap, goes 1 tick outside of it. Why? Remember what I was teaching you? It likes to create these little mohawks, okay? These little mohawks that overlap a little bit. Why? Because there has to be what? The bid and ask difference. So if a trader wants that 39.74.5, it has to trade where? 39.74.25. And that's what you got here. It's going to go up for buy stops, or it's going to go up to redeliver to an inefficiency like a fair value gap. It's either going to go up for that reason for longs to sell their long positions too, or it's going up there to start a new sell-off. So that way shorts can be implemented, and then it's going to be looking for an opposing liquidity. The market goes down for sell stops. It goes below in the low or at old lows, or it goes down to an inefficiency that it will reprice to. That's it. If it's not doing that, guess what it's doing? Consolidating. So what is it doing? It's consolidating. We're not trading. Why? Because it's likely to do this. And if it does move, it's uncertain. So you can't really trust it. So there you go. Now you know when the market's going to consolidate. I just taught you. I've taught you before, but I just reminded you this is what it looks like. But when you're bullish, and when I'm bullish, I'm looking for one of two things to happen. It's going to go up to buy stops above a high or relative equal highs, or it's going up to a premium fair value gap, some kind of inefficiency where the market has dropped in the previous, I don't know, it could be as far as 60 days back. Some old high, some old price decline where there is a fair value gap. It's going to go up into that level there to reprice. That's the only two reasons why price is going to go up for me. When we were down here, I said, watch that wick. Okay, that's not cherry picking. That's me taking your attention right to a very specific price level. The midpoint between the closing price and the low of that candle is consequent encroachment. And I told you, as this candle was dipping down in here, I said, watch that level right here. And then I said, we would want to see what? We want to see it trade back above, deeper into that 60-minute fair value gap, which is that pink shaded area. And more specifically, aim for the buy side liquidity resting above here. Why? Because we've already worked and utilized this fair value gap multiple times. So if it's going back up here, it's not going back up here for this. It's going back up for what? The buy stops resting above that. This failure swing, you can now anticipate them. If you have the backdrop, the foundation behind it, that we've already went below these lows for sell side, and it went to a level that would be expected. Think about what's going on here by doing that. I'm stating that the algorithm will go back down to this level, below these lows, go there, and be content with that, and then look to do what? Reprice for an opposing liquidity or inefficiency. We had both buy side and the remaining portion of that 60-minute fair value gap in the shaded area. I don't need it to go all the way up to the top. I just need it to go back to the buy side here. So smart money was buying below these lows. Notice it's doing that when it goes down here. This area here, which is the midpoint of this wick. Let me go back in case you guys just showed up. We were looking for this new week opening gap down here. It delivered it at 39.80 and 3/4. It came down to 39.50, 39.80.50. That's the low. Look up here in the upper left-hand corner. That candle's low is 39.80.50. One tick below consequent encroachment. That is below this low and this low. So the algorithm is remembering what? It's referring back to this low and this low because they're relatively equal. It does not know your stop. It doesn't know my stop. It doesn't know how many stops. Your broker does, but the algorithm has no idea. It doesn't reference it like that. It just refers to these points, these PD arrays. So the market does what? It reprices back down below those lows, which is a discount, and consequent encroachment. They're all measurable, and there's no need to go back down to that low. Why? Because it's already repriced to the new week opening gap. And done what? The sell side has been purged. This is just returning back to a point of reference for smart money to accumulate longs. If they're going to buy here in their quote-unquote smart money, and they are using what I teach as a market efficiency paradigm, that means they're going to buy stops that are below the market in the form of sell side, and they're going to distribute their long positions to buy side that's resting above the market. Willing buyers at a higher price. That's these stops right here. So they're buying sell side liquidity below these lows here and consequent encroachment. If they're buying that, what are they holding for? They're simply looking for the inefficiencies above the marketplace. Where is it in here? Nowhere. Here. We've already done that several times. Buying here, they're going to go exactly where I said it was going to go. The remaining portion of that 60-minute fair value gap up here that hasn't been traded to, once it went lower here, we've only delivered one time here. We went up to a quarter of it here, which is, again, not random. Then it went to halfway, consequent encroachment, and then ran through it. Like I said, that's where the buy side is. So smart money buys discount, sells to a premium. Buy stops at resting above here. They knew those buyers wanted to buy the market when it was down here. When they're down here, smart money, the paradigm shift that you're being taught to have in looking at price action, because it's algorithmic, is you're buying it here with the same mindset that they have. Smart money sees this as buying sell stops at the most opportune time. It's the precise time, folks. It's precise. You can't make it any better than this. The logic is right there. And buying that with the expectation of seeing it go where? Right to those buyers that want to buy high. Now, they don't want to buy high to buy a long position. They have they have a short, and they're holding on to their position here. Maybe there wasn't a lot of shorts. It doesn't make a difference because the algorithm doesn't know the level of float that resides above that. It means the number of orders. How many buy stops are resting above that high? I don't know. You won't ever know. The algorithm itself does not know. Buying it cheap, selling it to people that want to buy it higher. Why? Because I'm targeting their inability to know how to trade. From here, watch that. And we want to see it deliver up to this area again, but more specifically, the upper half. Why? Because it only went to here, leaving from this high up to the high shaded area here. That's not been repriced to. We only passed through one time here, then up to a quarter. So think about it like this. The range on that hourly fair value gap has been repriced to here, right there, at that moment. Then this high here takes it up to that level. So the remaining portion of that fair value gap, in my mind, I'm seeing that range left. I'm ignoring all this. So you're looking at all these things trying to guess which one I should have been looking at. I'm teaching you how to internalize it, because this is the part that the algorithm sees now. It doesn't need to look at all these other highs. This is the one that matters now, because it's traded up inside that old 60-minute fair value gap, but it's left in this portion of it where it has not redelivered to it. It's only been offered sell side. So the efficiency model is that price needs to trade up into that area and deliver price that way. It does two things. It does that redelivery and goes right for the buy stops I told you it was going to aim for. It's not chaos. It is not chaos. It's all scripted. Now, on better days, when we don't have the effects of a Fed chairman potentially saying something that could be utilized as a smokescreen and repriced completely outside of the scope of what would be reasonable, we can see trending days and keep on adding to the position until it rolls to the far extreme of the daily range, high or low. Some of you might like to think that that's the only way you're going to trade, and that's your model. Wonderful. That's nothing wrong with that. That's exactly what I'm doing this for. You're going to know exactly how you, not everybody collectively, how you yourself, the individual watching this right now, and every time I do a live stream, you're going to learn the thing that you resonate closest to, that makes the most sense to you. You're going to see something that says, you know what? Damn it, that's exactly how I see things, and that makes perfect sense. I'm doing that. I don't care about the fair value gap. I don't care about a breaker. I don't care about new week opening gaps. This is what I'm going to do. Wonderful. And when you get there, bloom where you're planted. Don't tinker with it. No matter what else I teach, don't tinker with it, because you're here to learn how to make money. The market's going to go where the money is. If there ain't the money in there, they're going to engineer it. That's the way it works. Above that high right here, buy stops. Somebody short. We don't know. Retail Rick, he's short here. He's going to put a protective stop loss in there because the books say put your stop loss right above the high. He feels great when it goes down. He's going through all this chop. He's thinking, okay, maybe it's just one of those moments where I have to wait. ICT talks about this right here as a fair value gap. I got to trust it. He don't know what he's doing because he watched 3 videos and now all of a sudden he's a professional, right? The market drops down. He's thinking, all right, I'm all in now. I'm adding to it. It's great. Go watch TV. Go play golf. I'm going to be good for the rest of the day. My stop's in place. What do he make? A mistake. He traded with logic that doesn't work. He doesn't know about the new week opening gap. He doesn't understand liquidity. He doesn't understand the facts that this day is going to be consolidation because of the Fed. The market's already delivered this week, folks. It went to that dollar objective. It's non-farm payroll week. Who's in a hurry right now? Who's in a hurry? What big money entity was going to think to themselves, you know what I need to do right now? I need to take all of our customer assets and put them at risk because non-farm payroll Friday is lit. We got to get in there and make all the money on Friday. Let's get in there ahead because, it might be a big mover. I'm sorry, but that's not how this business works. When you need a PhD level education, you need to understand how the human mind thinks, how it behaves under pressure. When it's in reward, they feel like they can't lose. And that's why you see these sudden rips other direction. They don't want to give them the chance to realize they're wrong and collapse their trade, and before removing what? Just like spoofing on the depth of the market, they don't want them to pull those orders. So what happens? They have to run for them aggressively and quickly. Otherwise, they can't participate and utilize them as counterparty to their selling of their long position they accumulated down here where I told you. Precision will escape you on these days over a large sample size. Once in a while, yes, I can get out there, I can call the low, trade the low, run up to near the high of the day on non-farm payroll. I can do those things, vice versa. Some of my students can do some of those things too. But does that mean it's a steady diet of every non-farm payroll we can do that? No. Sometimes the non-farm payroll event is a moot point. It just doesn't do anything. It looks like this right here. A little bit of a squirrely move at 8:30 and then doesn't do anything. And other days where it just really takes off and runs and runs and runs and runs, and who cares if it does? One day isn't your career. One trading day does not, and it should not, encapsulate your career. The market ain't moving, but it did what we were looking for. As small, as surgical as that was, that's all that was necessary for today. And when it does it, you stop. You move to the sidelines and be content. Even in your studies, be content with that. Close your charts, annotate them, and think to yourself, wow, we had a laboratory experiment today. We watched live price action. It behaved in a manner that was reasonable. It was expected. It made perfect sense. And now that it's done it, it's right back inside the range where everybody else is trying to figure out what it's going to do next when you don't need to worry about it. There's no necessity for you to know what it's going to do next because the profile of this day indicates that it's 50-50. So if it's 50-50, is that high probability? No.